Hello and welcome. Today we are going to take a look at Enbridge, which is a very popular stock in the Canadian stock market, especially among the income or dividend investors. Enbridge is an energy infrastructure company, and over the years it has proven to be a very stable dividend paying stock. But recently it has come under fire because the stock has taken a bit of a hit. If you look at its 6 months return, it is down about 11%. Even over the past 1 month, it is down almost 3%. But even more specifically, if we take a look at what happened on September 5th, the stock went from $48 straight down to $45 within the matter of a day. And this happened because on September 5th, Enbridge announced acquisition of three companies within the energy infrastructure business to expand its operation. But this acquisition is uh, funded through cash and debt, and this has caused some concerns among the investors, which has sort of led to a lot of people selling the Enbridge stock, causing the downward pressure. So, we are going to take a look at what this acquisition is, what does this mean for the company's future, and whether this is a good time to buy the Enbridge stock. Because despite this drop, they're still paying a pretty good dividend of over 7% right now, and there is a good chance that the stock would give you some capital gains and maybe even a dividend increase in the future if things go according to the way they have planned. So lots to get into. Let's get started. So as we can see on this article published on the Enbridge website itself, they're calling it a once in a generation opportunity. And let's take a look at what this opportunity brings us. So, Enbridge is basically acquiring a trio of US companies, all in the energy business, and this will make Enbridge North America's largest natural gas utility franchise, basically the largest natural gas utility company in North America once this acquisition is completed. The companies they're acquiring are the East Ohio Gas Company, Questar Gas, and the Public Service Company of North Carolina. What I want to highlight is how many new customers they will be acquiring with this. So with the East Ohio Gas Company, they are getting 1.2 million new customers. The same with Questar Gas, and with the Public Service Company of North Carolina, almost 600,000 new customers across 28 counties in North Carolina. So they're basically getting almost 3 million new customers with these acquisitions. And if we can really think about it, that means more revenue, more profits, and eventually with higher profits, we can expect them to pay a higher dividend somewhere in the future. Maybe I'm thinking maybe 2 or 3 years from now. It might happen sooner than that. But certainly, like once the sort of the storm settles down and people actually start thinking about this acquisition in a positive light rather than thinking it off as an expense, they might see the opportunity that the company is aiming for. And here you might wonder again, why is the stock down? That if this is a good thing, all these acquisitions are a good thing. They are making Enbridge the largest natural gas and utilities provider in the entire North America. Why are people skeptical of this move? One of the main reasons why investors are skeptical of this deal is because, according to many analysts, Enbridge may have taken a bigger bite than what they could chew. This is a huge acquisition deal, $14 billion worth of acquisition deal. And Enbridge has had a hard time raising the capital needed to complete this deal. So, as we can see on this article, Enbridge is raising about $4 billion by selling new shares at a discount of 7.2%. So, basically, they are diluting the current shareholders in order to raise some of the cash needed for this deal. So out of 14 billion, 4 billion are coming by diluting the current shareholders, and the remaining 10 billion are coming through debt. And that is another major concern that analysts have raised when it comes to Enbridge. As we can see on this paragraph, this additional debt has increased Enbridge's debt to EBITDA ratio to 4.9. And according to a lot of analysts, this leaves limited cushion for Enbridge to execute its funding plans. But we must question, is this a good or a bad ratio? So, ideally, this ratio for a healthy company should be below 3. But again, that can vary depending on one industry to another. A good example would be the tech industry and the price to earnings ratio, or the PE ratio. So, in general, a good price to earnings ratio should be less than 15, 1.5. But we see with a lot of tech companies that their price to earnings ratio is generally around 30 to 50. And even then, they are considered undervalued. So, that just depends on the industry. And if we look at the guidance given by Enbridge's management themselves, they are trying to keep it in the range of 4.5 to 5. The debt to EBITDA ratio, they're trying to keep it in the range of 4.5 to 5. So according to Enbridge management, even at 4.9, it is within the range they're aiming for, and it is something that is sustainable for them. And this actually is backed up by another ratio, which is the debt to equity ratio. So the debt to equity ratio basically tells us how solvent a company is. So basically, if Enbridge were to close down tomorrow, do they have enough assets to cover their long term debts? And in this case, the answer is yes. So a good debt to equity ratio is at 2 or below 2. And in case of Enbridge, it is right now at 1.3. So Enbridge does have the required number of assets to cover its long-term debts in case it were to shut down today, for example. So, in my opinion, the concerns raised by a number of analysts are are only sort of a short-term outlook on what its current position is, but they are not really taking into consideration the management's vision of how these acquisitions could help Enbridge grow further and how it is overall beneficial for Enbridge in the long term. So I have been personally buying shares of Enbridge ever since this recent price drop happened, and my cost basis is below $46. In my opinion, this recent pullback in the stock's price is mainly due to two factors. Number one being the fact that analysts are creating an atmosphere of uncertainty by doubting Enbridge's ability to pay off its debt. And the second factor being the fact that Enbridge themselves diluted their share value by issuing more shares at a discounted price. But in the long term, we can expect Enbridge to recover once these short term uncertainties are dealt with. And as the stock recovers, we can also expect that Enbridge might increase its dividend yield in the future, giving us a higher income proportionate to its current stock price. So, for me personally, this is a great time to buy the Enbridge stock and sort of lock in a lower cost basis and receive a higher dividend yield in the future. But again, do your own research before investing in this stock. Maybe it's possible I might have missed out on certain factors that might not go Enbridge's way, and it might just end up going downhill even further. Let me know in the comments section, what do you think about this stock? Is it a good stock to buy now? Or did the management really did make a mistake by making these acquisitions? Thanks for watching. If you found this video useful, don't forget to like, share, and subscribe. See you in the next one.